There is a lot of news coming up in the week ahead on both the macroeconomic and company fronts. Top down, watch for the latest UK consumer confidence figures from GfK on Wednesday the 31st of January. The December reading was -13, the lowest score in 4 years. Now that may explain why some retailers have been having such a tough time, but also look out for the major purchase sub-index. Here, GfK asks survey respondents if now is a good time to buy and make a major purchase. December's reading, as you can see here, was -4, the worst score since October 2014. Now I don't know about you, but I can think of no bigger purchase than a house. And look at how the Halifax House Price Index has tended to track the GfK major purchase reading. Now we all know the past is no guarantee for the future, but you do have to wonder what house prices will do, and therefore house building stocks might do, if, and I stress if, consumer sentiment remains depressed by how inflation continues to run ahead of wage growth. We shall see. The other big macro feature of the week is the US Federal Reserve's latest monetary policy decision on Wednesday the 31st of January. The central bank is expected to leave interest rates unchanged at 1.5%, but watch out for any hints on whether it still plans 3 1/4 point hikes or not for the rest of this year. The market expects the first of those to come in March, according to the CME FedWatch tool. Now this matters because 3 hikes this year would take the total to 8 for this tightening cycle since December 2015. And on average since 1970, it's taken 8 to 9 rate hikes to stop US stocks in their tracks. Although as we can see here, the range is wide and we must again accept history is not certain to repeat itself. Now on the company front, a good handful of FTSE 100 and 250 companies are due to publish results or trading statements this week. They include Domino's Pizza on Tuesday the 30th of January, utility SSE, drinks group Britvic and airline Wizz on the 31st, FTSE 100 heavyweights Royal Dutch Shell and Vodafone on Thursday the 1st of February, and then AstraZeneca and BT on Friday the 2nd of February. But for me, the company really capable of causing a fuss is Unilever when it reports full year results on Thursday the 1st of February. The Anglo-Dutch food to personal care and hygiene giant owns well-known brands such as Knorr, Ben & Jerry's, Marmite, Persil, Domestos and many more besides. And as we can see here, the share shot up last February after American firm Kraft Heinz offered just under $50 a share in cash and stock in a takeover bid, something like £40 a share, depending on the exchange rate, and that was an 18% premium to the Unilever shares at the time. Now, Unilever rejected that offer out of hand and Kraft Heinz promptly withdrew, but the approach clearly gave Unilever a shock. Chief Executive Paul Polman swiftly followed up the strategic review and new financial targets. These included a plan to drive operating margins from the mid to high teens to 20% by 2020, the disposal of the spreads operation, which includes the Flora margarine and Stork butter businesses, and a review of the Anglo-Dutch legal structure, and a €5 billion share buyback programme. Now, the buyback concluded in September, and the spreads business was sold for €6.8 billion in December, but the shares have sagged anyway, and are now barely above the putative American offer price of a year ago. That puts some heat back on the company and Mr. Polman, so when it comes to the full year results, there'll be 3 things to watch. First, any update from Polman on the strategy, financial targets, and how the money from the spreads disposal will be used. Second, underlying sales growth. Unilever has a target of 3 to 5% a year, and as we can see, it slipped below the 3% level again in the third quarter, although the consensus forecast is for 3% across the year as a whole. Also, check out the mix between volumes and price. The brands mean Unilever is seen as a pricing power stock, and in the third quarter, volumes were up 0.2% while prices were up 2.4%. Looking at this chart, volumes haven't really grown much for 5 or 6 quarters, which may explain the latest softness in the share price. Remember that Piers Mondelez and Reckitt Benckiser both warned about tough markets in 2017, even if they then tried to pin the problems on the pettiest cyber attack. And the third item to note is profits, of course. For the full year, analysts are looking for a stated operating profit of €8.7 billion, so watch for any comments on the overall outlook. That, by the way, implies a margin of 16.2% compared to the 20% target. After all of that for 2017, watch out for guidance for the year ahead, 2018. According to the company website, the analyst consensus is looking for broadly flat sales of €53.7 billion, a 5% increase in stated operating profit to €9.1 billion for a 17% operating margin, and an 8% increase in earnings per share on an underlying basis to €2.40. So thank you for watching, and I look forward to seeing you next time.